Thank you very much for being here today.
There's a microphone on this page, not the radio.
For the purpose of identification, Purdy with banking consultant out of Washington and a long-time observer of the FDIC. If covered bonds are to take off as a financing vehicle in the U.S. for U.S. institutions, then that's going to raise a related issue, and that is the increased capital required under the leverage ratio, which of course is basically 5%, regardless of the caliber of the asset, in order to be a well-capitalized bank. My question is this: if covered bonds were to become increasingly attractive as a financing vehicle for American chartered institutions, under what circumstances would the FDIC begin to reconsider its position as to the maintenance of the leverage ratio, whether it's a dropping of the percentage or some type of modification of it? Because right now, it frankly is a major barrier to holding low-risk assets on balance sheet, which of course is a consequence of the bank issuing covered bonds.
Well, I don't see us in the foreseeable future entertaining any changes to the leverage ratio. I think that issue's off the table with all the bank regulators. And I think, I would look at this in a little bit different way. If you want to promote regulatory acceptance and facilitation of covered bond deals, but one of the advantages of it is that you are looking at it on the balance sheet, and capital will be held against it. You know, I think really the debate now, Bert, is not so much with whether our capital standards have been too high, but whether they have not been sufficient to cover securitization risk and assets that we send off balance sheet. There really was so much social risk exposure there, because the risk-based capital regime, whether Basel I or Basel II, it has nothing to do with reputational risk or market risk. But here, I think in particular, reputational risk is a key issue regarding to securitization exposures and the FIP problems we're having now. There's a lot of risk there in those moved off balance sheet. So the leverage ratio is one of the ways that we try to capture these additional risks that are not captured in the risk-based framework. And I really think going forward that the issue for bank regulators is making sure there's adequate capital, not entertaining initiatives that are least potential.
Any other questions here? Yeah, over on the right there. Microphone on the second.
At the very beginning of your remarks, you said that the FDIC doesn't have a position today. Do you have an informal or formal timeline as to when you expect to take a position?
Well, I think that there's an ongoing dialogue going on with the industry. From you, I guess I would like a little more guidance about what you need from us. I think if there's I know the 90-day stay issue has been something that has been in staff level discussions on. Mike Kriminger, my staff, is really our expert on this issue. We'll probably talk about that later. I think it's very difficult for a regulator to say, you know, in a resolution situation, we can do X, but maybe something short of that. I do think that this is a trend that we need to see develop. I think there's some potential very positive with the covered bond market, but we really don't have enough information right now. So there's a way we can facilitate and guide, growing development of this within a framework that ensures that our interest protection in terms of exposure to the cost of insurance reserves and the risk of failure, or would not be. That's really the balance we need to make. And I know for instance, limits on assets, which includes the FSA approach, maybe we should look at that. The deals below represent below a certain percentage of total assets. Maybe that's a new would be more flexible. I think there's a lot of approaches we might consider, but I do think it would be helpful to get a little more information from the industry to the level of comfort they need. I think getting very specific about what we do in resolution situations